Good morning, y'all. I'm Catherine Ross with TheStreet. I'm here on the floor of the NYSE with Jim Cramer. Jim, you wrote a Real Money piece this morning about market referees.
Yeah, well, man, I'm just sitting here thinking about the national outpour of rage about a ref who didn't call a personal foul and didn't call it interference, didn't call helmet to helmet. And it's rippling around the country. I mean, it's almost as if everybody just feels like it's totally agreed. There are people who feel like there should be a do-over even in New Orleans. New Orleans, great football town. And then I look at what happened on Christmas Eve, where the market went down really badly, and it was a very light day of trading. And there were no refs. I mean, it just went down. It's one of the reasons why we were holding it down 19.8%. It's also one of the reasons why, and this is the important thing, we're not going to have people coming into our stadium. If you think the game is rigged, or if you think that the game is too dangerous and the asset class is from hell, which is what happened with the flash crash, what happened in 2015 in August, what happened in 2016 in February, what happened in 2018 in February. These are all examples of extraneous failure, mechanical failure of the stock market. And because of those, there are people who continue to leave the stock market, or they just own S&P. I mean, now there is a lot of brainwashing that you should only own the S&P because you can never beat the market. Well, I mean, look, if you bought Apple, or if you bought Amazon, if you bought Facebook, if you bought Netflix, these are all accessible. We all knew them. As much as I miss the late Jack Bogle, I have never bought in to the idea that you can't find these. Now, there are professors who hate me, and I've been cheap shotted all over the place. But what I try to do is point people toward high growth. And you can't get them to look at high growth if they're not in the stadium. And so what happens, and what I'm calling for, is some sort of at least remonstration, if not some investigation. It's not just a committee that would get together and say, well, how do we attract people? Almost like if the NFL were to say, okay, well, listen, they're immediately starting to think, do we have to have replays for refs? What do we do? They immediately try to adjust. We don't do anything. Is it the exchanges? Is it the companies? Is it the SEC? I don't know. But we have lost so many people being interested in stocks. I was talking about this with my wife, Lisa. And Lisa was saying, Jim, you still care. And I said, well, I do care. She goes, well, very few people other than you care. And I said, well, there are people who care, and those who do care should watch our videos and subscribe to Action Alerts, read Real Money. But it is painful to realize that you could have a day like the day before Christmas and nobody cares. And yet we lost a huge number of people, just like we lost on the VIX fiasco in February of 2018. It's just making me, it's a little bit of a cause that I'm going to have in 2019, which is that if you corrupt the game, or if you corrupt investing, I'm using the analogy of game. It's not a game, it's about investment. If you corrupt it and you make it seem like that it's not fair, you're right, it isn't fair because the machines don't work. And we need to find out how to get the machines to work. Maybe we shouldn't have been open that day. Maybe we should have been closed for 2 days and they just wanted to have more business. But that was a light trading day, and it was a day where a lot of people lost a lot of money. But more important, a lot of people decided to leave, and not just go into index funds, but leave. And this is much more of an issue now than it was in the different flash crashes I mentioned, because CD rates are up so much. So, I mean, I've never recommended CDs, but I feel like they're integral now because of these mechanical failures.
I mean, I was covering it on TheStreet's Twitter account, and it was just crazy to see how quickly it was just dropping.
Yeah, well, because it doesn't work. I mean, the market, because of the way high-frequency trading works and how so many people are on the same side. I mean, look, I could have written that piece 3,000 words. I was trying to keep it to 900 so that people can go through it. But look at the way high-frequency works. If the programs are all set for the same outcome, then there's no way you can possibly find buyers. Now, in the old days, you used to do order imbalances. They stopped doing that, so you could at least reload and find buyers because there were some great bargains that day. But the bargains are created by the machines overwhelming the system, overwhelming the actual mechanics, and so the asset class has become tenuous. It doesn't seem like that's something that could have a flash crash in 2010, flash crash in 2015, flash crash in 2016, 2 flash crashes in 2018, that merits investment for your nest egg, for vacation retirement spend. so you have enough money when you get older. And I'm not going to disagree with that. I think we really need to make some major changes in the way that stocks are traded. I am a lonely voice on this because no one speaks up for the individual investor. In the old days, the New York Stock Exchange used to, and the SEC did. But no one cares now, and I just find it outrageous because it's such a great thing. Our stock market being liquid and deep is a great thing for our country, and it's not talked about by anybody. And we talk more about index funds, and we certainly talk more about a very bad call that would have put the Saints in the NFC Championship.
All right, and of course you can find Jim's Real Money column over on realmoney.com.
Real Money's up a lot. More and more people reading it, and I think a lot of it's this video because people didn't know. I've been blogging there. I've written about 50,000 stories since 1998 when we created we actually created Real Money in 97. I always made people pay. We were the only first site that ever made people pay, and people always said, well, listen, you'll never grow. But all the other guys who started went out of business at the same time. There were 330 IPOs when we came public, and only 3 of the companies survived. We're one of them.
Today we started on an up day, and it looks like we're about almost 300 points up. What are you thinking?
Well, I'll tell you what's really interesting, Catherine. Yesterday was macro day. And it was, well, what is Jay Powell thinking? And what is Peter Navarro thinking? And what is Larry Kudlow thinking? And what is Christine Lagarde thinking? What's the mood of Davos? And it was all grim. Today, it's a micro day. We're actually literally looking at the companies in the Dow. We're looking at Procter & Gamble, which is a remarkable quarter. Some of their lines were mid-single-digit growth, organic growth. IBM, which was a very good quarter, and there's some people who want to play it down because the revenue growth was still not great. But I like the pastiche that's developing. I like this hybrid cloud story, and I like what Red Hat will do. I think Red Hat will really accelerate growth. They did not talk about Red Hat on the call. I'm telling you, that's my own work. We have a recommendation from Morgan Stanley that Walmart is a flywheel situation where the elevated same-store sales are going to continue at +3, and that the gross margins are not going to be under pressure despite the incredible .com that they've developed, which is really, really powerful. And then best of all, we had United Technologies reporting a really remarkable number. A good read-through, by the way, to Action Alert named Honeywell. Tells me we should be buying Honeywell right here. United Technologies, aerospace was a double-digit organic. The Rockwell Collins was genius. The split into 3 companies will happen next year, a little ahead of where people thought, and much faster than Dow DuPont. And I say that reluctantly because Dow DuPont has been a big disappointment for us.
And if you didn't already know it, IBM is Real Money's stock of the day, so you can go and find one.
IBM is an inexpensive stock that's going to increase the dividend. They're going to drop the buyback, and we'll talk about that with Comcast dropping the buyback in our paid, in our Held for Action Alerts club members. But I like what I see. I just like what I see in IBM, and I know that there are people who truly don't want to like IBM. Fool me once, fool me twice, But the third quarter had some weak numbers when it came to these strategic imperatives, and the fourth quarter brought them all back. And they told you to not make it in 90 days be the judgment, and they were right. And so I was very, very cheered by IBM. I think it was very, very good quarter.
And when I last checked, it was up about 8%.
Well, it should be. It shouldn't have been where it was. I think that's what's important. And I think that I am always been a big fan of Jim Whitehurst and Red Hat. If you ask Jim who was his earliest supporter, it was me when he came over from airlines. And I just have always liked him. I think he's a very courageous guy. The more he's engaged, the more the on-ramp will be Switzerland-like, and it's going to give people a run for the money, Catherine. It's a good situation.
Let's talk Tesla, which is not going to give people a run for the money.
Tesla's so hard.
Well, and did you see that there are more analysts with sell ratings than buy ratings now?
Yeah, and so there's big short position, and there are people. I've been doing this. My Twitter feed is blown up because I've been talking about who really innovates. And you come back.
I saw that.
Yeah, and you come back and the answer is Amazon and Tesla, Amazon and Tesla, Amazon and Tesla. And because of that, I'm reluctant to tell people to get out of the damn thing because when you see that fount of innovation, as Carl Quintanilla was talking about, there is a premium because of Musk. And it is, how dare I tell someone who has a Tesla that they should not own the stock?
Okay, what about the U.S.-China trade talks? It's
Well,
going back and forth.
Look, this is one where I talk to everybody, and there's factions in the White House. One faction really wants a deal. One faction wants a deal, but only on the terms that the Chinese probably will not go for. So what this says is the speed with which we expect a deal is not there. I think it's going to go right to the wire, which is the 25% tariff. I think the 25% tariff is bad for cut earnings. If we don't get that, the market can really roar. We get a deal, the market roars, because if you look at the Williams-Sonoma downgrade to sell, it talks about the exposure to the tariffs. All the retailers have big exposure to the tariffs. Companies are trying dramatically to get out of China. I had Baccardax on last night, who's the CEO of Logitech that was upgraded today, I think JP Morgan. And he produces a huge amount of product, comes from China. And he's frantically trying to get it out of China, frantically. So if you're the Chinese Communist Party, you're looking at who's trying to move out. And you might be able to say, our economy is going to drop to 5% growth, and that's unacceptable. And the reason why Xi is so revered by the elites in our country is that he is regarded as being unshakable, and that the 6% plus growth is preordained. And I think that's beginning to become more of a chimerical view. I think that Xi, I don't say he's in trouble, powerful leader. I will say that when you listen to the Baccardax of the world, and they're trying to get Logitech, which is all these little devices that we all know, that are really made in China. These are made in China devices. And he wants them out, shift to India maybe, shift to Vietnam. It's happening. And it's happening because people fear Trump. They fear Trump. They fear that if they don't move out of China, they will lose their gross margins. And they're right to fear Trump, because the difference between Trump and Xi is that Trump's crazy. Totally unpredictable. Xi's predictable. Always bet on unpredictable. You have to bet on unpredictable because it's too much of a wild card. So what's happened is that if you're Williams-Sonoma and you see the downgrade, you're like saying, okay, who can make this stuff? Is there somebody in Cambodia that can make this stuff? You have to. And I think people really have to understand this is happening in real time. Now, you could also argue, well, wait a second, Nike and Starbucks are doing quite well. They have huge businesses in China. But that's not disputed. So does Apple. What is important is to recognize that if you have a whole country where people are trying to offshore, you can make things in Mexico very cheap. Then what happens is, quickly you can put up plants. China loses those workers. And this is happening right now. So the invincible Xi is up against the mercurial Trump. Go with mercurial.
Okay, we got to switch over because I want to talk to you about Comcast and Abbott and all those earnings.
Go to our club call. But look, I'm excited that when we see the actual earnings of companies are very good. Now, understand that there's a negative undertone. The futures want to go lower. Why? Because the futures are still locked into the oil Fed dilemma. Now, maybe the Fed raises, Jamie Dimon saying that. When it's about Fed and it's about oil, it's going to go down. When it's about earnings, it's going to go up. And it's pretty amazing.
All right, Jim, thanks for all your insight. Thanks for joining us, y'all. We'll see you tomorrow.